is one of the chief executive officers. She is going to further talk about the acquisitions and the process that the company is going towards.
Thank you, Wade. So you've heard about that we've made some key financial decisions for 2015. So we're moving forward. One of those key decisions has been the acquisition of Natural Motion. This is advanced technology out of London, and it's really cool. What it does is it allows our gaming characters to move in sort of real time, you know, with each other, and our players really like it. Natural Motion has also given us the ability to create 3D animated racing car games, which has been really profitable for Zynga. Also, here are some of the top sellers. Again, we're having all these new launches that we're doing since the second quarter 2015. As we've already said, we are giving these out free. Who doesn't want an app free? So we give them free. But you've heard, we make money out of these apps. And something else we do, another revenue source from our free apps, is the fact that we advertise on them. Little banners, advertising. And if the player reads them, they get a benefit, a diamond or something, I don't know, depends on the game. And then we, of course, get revenue from the companies. So that's another source of revenue for Zynga. Something else that we've done is reduction of our workforce worldwide by 18%. And this has really helped our overhead dramatically. Along with the reduction of the salaries has been the reduction of overhead expenses associated with the employees and a cutback in facilities. We have, along the same line, we have hired, not 18% higher, but we've hired a new group of young, innovative game designers who are all fired up and who've come with some great ideas and are working together, and we're all excited about what they're doing. We have a culture of meritocracy, and what that means is we are rewarding these young people on the merits that they are providing for Zynga. And it's a great incentive, and it's working. We also cut back, or we actually closed our Beijing studio. The reason for that is that the studio was built to provide gaming for China, but it just didn't come together, and so we closed it, and we now do not have that overhead. So Don Merrick has been CEO for almost 3 years, and he did some good things, but he wasn't able to turn around Zynga as we had hoped. And so our founder, Mark Pincus, came back in, same day that Don left, little joint agreement. And also when Don was in, he appointed, handpicked pretty much all of his executives. So a lot of them have left, such as Clive Donnie. Now, if you look at the salaries these people were making, it was pretty exorbitant. Mark, on the other hand, is being paid, at his request, $1 per year as CEO of Zynga. But he owns 10% of the stock and 60% of the voting rights on the board. Okay. We've also, you've heard about the platform situations like with Facebook. We're renegotiating with Facebook. We've also done with Google Play and Android. So we are working on improving our Facebook presence, our platform presence. We've also built our own platform, which has really helped us. And then as far as player acquisition, we are doing more marketing. We're marketing our games out there more than we did before. We were really reliant on Facebook. Now we're looking more at ourselves, getting the word out there, driving people to our platform. So we are also becoming more international. We're trying to get our presence out more internationally. We're being cautious because of what happened in China. And so, but we are in India, and we're doing great in India. We've hired local managers executives, game designers who have the mindset of the local population. They know what people want and they're delivering, and we're being very successful in India, and we're using that with our future international efforts. So our SWOT analysis is for macroeconomic conditions, a little build up on our pest analysis. And of course, social media communication is what we've all been talking about, and we love it. And that goes hand in hand with the growth in smartphones. Did you know that more people worldwide have smartphones than they have toothbrushes? Anyway, some of our...
There's an app for that too.
Yeah, there are. So as far as weakness is concerned, of course there's intense competition, so low barrier of entry, and then technology changes can happen anytime, they do, and that will impact our games. We might have to reconfigure some of our games. It's out of our control, but we will have to react to them. Reliance on the cloud, we all have that we have to look forward to, or what, as it changes. And then threats, Tony. So as already discussed, the problems with China. China blocked Facebook, and so yes, that had a big impact on us. And then the fluctuations in foreign currency exchange rates, and we are based on the US dollar, so that could impact our bottom line as we deal more with international gaming. And so other macro situations, conditions that impact us, data breach, for piracy, changes in the US tax codes, and then industry regulations that change all the time. And then, of course, our home is in San Francisco. And there could be an earthquake in San Francisco, and that would impact us dramatically. And so I'd like to turn over to Raj.
Thank you, team, for piecing together a nice story for our company. Now it's time to get down and dirty with the numbers. Actually see how the numbers came there, what do they mean. Before doing that, let's take a quick poll. How many people in this room has played some kind of Zynga game? All right, so we have like a good representation here. Quick trivia facts for you guys. Farmville has been so far like one of the most popular social media type of game. The beauty of this game is this game was developed in just 5 weeks of development cycle, and that is something unheard of. Typically these kind of games take like close to 6 months for development. One more interesting fact is people use like close to $1 billion annually to buy like online goodies for games like that. So that show you like a kind of pie we are looking at. It's a big pie and everybody wants a piece of it. So that's pretty much it. Let's look at the numbers and how we got there. Our first calculation here is beta, and as you can see here, we have done like our consultants have done an excellent job in doing this sophisticated analysis. We have used S&P index as our benchmark. Why we use that? I mean, you need to have some kind of steady index, market index to show you the broader market conditions, and we have pitched our company against that. And selecting this true axis, we have spotted the numbers there, and there is a trend line. The slope of this trend line is giving us the beta, all right, and that is for us it's coming out to be 0.43. Now what does this number mean? This means that our company is less prone to fluctuations. So as compared to market, if market's fluctuations is 1, then we are 1 minus 43, which is like a 57% less volatile than market. We have also calculated the alpha values there, and standard deviation and R squared values are there. And we'll quickly look at our competitor. King is our closest competitor in terms of like what the things that they are doing, and if we look at them, their beta comes out to be 1.87, and that means that as compared to the market, they are 87% more volatile. So we can see some price fluctuations over there. Next slide. Then we go to the next calculation is the cost that we are looking at. This piece becomes pretty much simple because we see that we have hardly any debt at this point. Long-term debt is 0. Straight away we have the left-hand side of the equation goes to 0, and we get the cost to be 7%. What does that mean? For any future Zynga projects, we need to have like more than 7% return to make it like viable. 7% is a pretty good number. It compares well with industry, and I think you investors should be happy with that. Then we come to the next evaluation part. We are looking at some of the factors which you'll consider for your investment. Let's look at first all the factors that are weighing us down. And as you can see, the red factors here are totally related to the growth. It boils down to the difficult environment in which we are doing the business. You know, ours is like a cutthroat business. We are finding it very difficult to grow in this business. Of course, we are taking multiple steps as my colleagues have explained, but we are getting a lot of resistance on this side, and that's why you can see like EPS growth, revenue growth, book value per share growth. They are not really great. One other factor we have been marked as negative is dividends. We are not paying any dividends at this time, which may not be necessarily a bad thing. We are using all our money right now for ourselves in our R&D and all the other investment activities. Of course, for some of the activist investors in you, it may not be a good thing, and that's why we have just flagged it as a red. Let's go to the next thing. Okay, so this is one slide which may not be a great visibly great slide for you guys. As you can see, we have PE ratio in negative. I mean, typically if you have negative PE ratio, it's not reported on the charts. It's reported as null. The main reason for this is at this moment we are doing a lot of different things. We are doing a lot of investment in our research and development. We are also doing some good acquisitions. We are working on a lot of new patents. In last 2 years, we have doubled our portfolio, patent portfolio. So all these things is getting reflected in this chart. Also, this is like an analyst estimate, and with all the changes that we are going through with the new management, I'm pretty sure we are going to beat these estimates.
These trends basically are just showing, if you go back to the trend is just showing, yes, at this time, as the market stands, as we stand, as Zynga, we're losing money, but we're taking every single step from here on out to turn those trends around and take it in the topwards direction. Just a heads up for you guys.
Right. So next, look at two more important ratios: price to book ratio and price to sales ratio. Price to book ratio, we are at this point very low, less than 2. One meaning of this can be like investors are not really happy with us and they don't value us that much. But in real terms, at this point we are undervalued because of some transitory reasons. We are working on these factors and pretty sure it is going to be a really good investment option. So this is actually really good investment opportunities for all investors like you, and that's why this is like we have marked this as a pass. The second ratio is P to S ratio. You need like a comparison for this. We have taken our closest competitor King in this aspect, and as you can see, King is undervalued in terms of P to S ratio, and that's why we have marked it as fail. So guys, so far we have seen like all the different factors about Zynga. To sum it up, we are the pioneers in the online gaming industry, especially the social media part of it. We have like amazing user base. We have like millions of users. They are pretty loyal to us. We have faced some threats, some problems in our growth department, but we are taking a number of steps to correct this thing. We have a lot of good products in the pipeline, and as my colleagues have explained, it just takes like one or two of these products to click, and our revenues are going to zoom up again. As my colleague Ray here has talked about that notorious list, our first job is to get off the list, and I'm pretty sure we are going to be those 10% of those companies which can prevail against the market conditions and make it big. So we definitely don't want to become those dinosaurs which we are not able to adapt to the changes, but we want to become like we want to innovate and become that next big thing. So if you are looking for a nice value stock in the market and with a good basics and low volatility, then Zynga exactly fits the bill. Thank you.
Alright, bring it up. Go ahead, Lorelai.
Tackle the most difficult one.
For one very good presentation, a lot of details there. I like the earlier slides where you have shown us where Zynga is as compared to your competition. It's really very good. The pest control, SWOT analysis, the pest, SWOT analysis, porters, what else you have? You have all those, right? So it's really very good. Good job, team. So my question is, can you talk about more on your target segmentation, target market segmentation, the market segmentation as compared to your competition? Because you've mentioned that there's growth in the casino related games, but that may be targeting an adult type of market, right? And so that's one as compared to your competition. And the
Only one question, please.
but it's all related. And the other one is because people when they're done with it's about customer retention, right? How are you? What's your strategy for customer retention? Because once you finish a game, people move on, right? And if for example they're in the middle of that game, but a new game came in, people would move. So is there any strategy for customer?
Okay, so
I thought you were giving us feedback.
I can take take the first part of that question.
I'll take the second part.
Market segment. So basically, Zynga is pretty broad in terms of market segment. So our main core market, or this main core segment is this online social media type of games, and that segment varies a lot in terms of demographics. We are targeting like a teenager to pretty adult crowd, and depending on each game, the segment differs. So that way we are like covering like most of the market. It's like a broad spectrum, and I will say like a lot of these games, in fact, most of these games are mobile-based games. So that is like one kind of characteristics of this game. Second part.
And to address the retention of our customers, so that is part of the reason why we did the refresh for Farmville. And when you do a new iteration or a refresh of a game, an existing game,